Hello everyone, I am Pavithra, Assistant Professor, Department of Commerce, Computer Application in Holy Cross College. Now I am talking on Introduction to Depreciation and its types. A small introduction about learning objectives to understand the basic concept of depreciation and what are all the types are available in depreciation and how to compute the depreciation and know the impact of in fixed asset. Introduction about depreciation. It is a method used to allocate the cost which is on a fixed asset which is in physical or tangible in nature. The definitions are Orrin Carter offered a definition on it is a gradual or permanent decrease in value on fixed asset. Second definition, William Pickles, he talk about it is a permanent and continuing depreciation which is charged on fixed asset. The features are the decrease amount on book value about a fixed asset, it is chargeable on, it is considered as non-cash expenses because depreciation is considered as a loss. So, it is considered as non-cash expenses. Continue process means from the beginning of a fixed asset, the depreciation was charged at every year. So, it is called as a continuous process. It is charged against profit. Now, I already told that it is considered as a loss, so it is just against to profit. For tax benefit, we calculate depreciation on fixed asset. For useful life, what are all the causes to make the depreciation? First one, to constant usage of fixed asset. For example, a machinery was purchased from 2000, it is used till 2010. 2002 to 2010 is a useful life of the machinery. So, we use the machinery every year. So, due to some causes, it is depreciated. Second one, by passing of time. By passing of time means we can use the machinery or fixed asset during the year. So, due to time constraint, it is depreciated. Obsolescence. By obsolescence means some of the machinery or plant is outdated due to technology innovation. So, we have to adopt the fixed asset based on the changes, rapid changes. So, due to obsolescence, the fixed asset can be depreciated. By expiration of legal rights, especially some of the assets have legal rights to use particular period of time. So, that particular period of time we have to calculate depreciation. By accident, it is caused by either naturally means fire accident, flood, this is called natural accident. Another hand, it is made with uncertain situation. Uncertain situation means some other causes may occur unexpectedly. So, by accident based, the depreciation was calculated. The types of depreciation is, there is numerous type is available, but these 5 methods are basic methods calculated in depreciation. First one, straight line method. Second, diminishing balance method. Double decline balance method, unit of production, sum of year digit. These 5 are discussed with below slides. The straight line method means it refers the depreciation chargeable amount is equal for every year. If the life of machinery is 5 years means first year we charge 10,000 as depreciation. 10,000 is continuable for every year. It is non-changeable in nature, that is called straight line method. It is calculated on fixed asset original value. Original value, for example, 1 lakh as original value means 10% depreciation rate. So, we have to 1 lakh into 10% is equal to 10,000. 10,000 is chargeable at every year. The formula are cost of fixed asset minus scrap value divided by useful life of fixed asset. This is the formula for calculating straight line method. For example, show one sum, one problem. The machinery was purchased 95,000 and installation charges was 5,000. So, the total fixed asset value is 95,000 plus installation 5,000. Totally 1 lakh. 1 lakh is considered as a total fixed value. Then the depreciation was charged at 5% on fixed method. Fixed method is otherwise called straight line method. The life of asset is 3 years. Compute the machinery account for 3 years. Now, we calculate the machinery account with depreciation. To bank account means this entry for purchasing machinery. So 95,000 the original cost plus installation charges 5,000. Totally the machine cost is 1 lakh. 1 lakh. By depreciation account 10%, 5% is calculated on 1 lakh. So 1 lakh into 5% is equal to 5,000. We less 1 lakh minus 5,000. The balance carried down was 95,000. This 95,000 is considered as closing balance of first year. The closing balance of first year will come at a beginning of second year. So to balance brought down 95,000. Same 5,000 depreciation charged on machinery. The closing balance of first year will come as opening balance for second year. 95,000 to balance brought down. The same 5,000 depreciation was charged on second year. The balance carried down is 90,000. The closing balance will come as opening balance for third year 90,000. Same 5,000 depreciation was charged. The closing balance is 85,000 at the end of third year. This is called straight line method of depreciation. Diminishing balance method, same as straight line. A chargeable depreciation amount is different for every year. For example, first it is chargeable on book value of that particular year, not on fixed cost or original cost of the asset. It is calculated on book value of the particular year. The formula are book value minus scrap value into rate of depreciation. The machinery was purchased same 95,000, installation charges 1 lakh, depreciation charged at 5%, calculate life of asset is 3 years, calculate machinery account. Same sum, but we proceed with diminishing balance method. First we have to mention purchase, machinery purchased. So to bank account 95,000 plus 5,000, 1 lakh. The depreciation was charged on book value of that particular year. 1 lakh into 5,000, 5% is equal to 5,000. To balance brought down 95,000. Now it is carry forward to next year. The book value is considered as 95,000, not 1 lakh. So we calculate depreciation for second year on that book value. So 95,000 into 5% is equal to 4,750. So a depreciation amount was less in book value. The balance carried down was 90,250. That closing balance carried down to next year, that is third year. The opening balance is 90,250. The depreciation was charged on book value of third year. So 80,000 into 5% is equal to 4,512.5. It is less in book value. The closing balance is 85,737.5. This is called diminishing balance method. Third method is double declining balance method. The name itself, it clearly explains it is chargeable at double time. So the formula are net book value minus salvage value into rate of depreciation into 2. As per double declining method, we multiplied into 2. The sum are the machinery was purchased rupees 50,000. They have estimated the machinery useful life is 5 years. The depreciation was charged at 6%. Calculate the salvage value. Salvage value means end of the year the particular value is remaining. That remaining value is called as salvage value. Okay. The formula is, first we have to find depreciation rate, that is depreciation percentage per unit we have to find. For the depreciation rate, the formula are fixed asset cost minus salvage unit divided by number of units produced during the useful year. Depreciation is equal to, now we comes under main aspect, depreciation is equal to number of units produced in given year into rate of depreciation. The problems are machinery was purchased 50,000, the cost of machinery is 50,000, has estimated use of 20,000 hours. That particular machinery was used during 20,000 hours. The first year said equipment was used for 4,000 hours. First year, especially in the first year, it is used for 4,000 hours. Therefore, the estimated salvage value is 4,000, and at the end of the year, the salvage value is 4,000. Now, we calculate depreciation amount per unit. because it is unit cost method. Depreciation per unit is equal to 50,000 minus salvage, that is original cost 50,000 minus salvage value is equal to 50,000 minus 4,000 divided by 20,000 hours is equal to 2.3 rupees per hour. Per hour rate is 2.3. Now we have to convert into 4,000 hours. Depreciation expense is equal to 4,000 hours into, we calculated already, 2.3 per hour is equal to 9,200. So, value of asset depreciation. Total value of asset depreciation is equal to total cost 50,000 minus depreciation value is 9,200. So, at the end of the year, the value of the asset is 40,800 only. Fifth method, sum of year digit method. It is total useful years considered as a sum of digit method. The year are assigning in descending order. For example, 5 years means 5 plus 4 plus 3 plus 2 plus 1. That is called sum of digit year method. Depreciation is equal to, the formula is depreciation is equal to useful life remaining divided by number of year digit into 100 into depreciable fixed asset value. The sum are machinery purchased on for rupees 40,000, 45,000, installation charges were 5,000. Totally the total value of asset is 45,000 plus 5,000. Totally is considered as 50,000 as fixed value. The useful machinery life is 3 years and it was sold at rupees 10,000. Finally, we sold at 10,000. Depreciation amount is equal to 45,000 plus 5,000, that is original cost. Purchase cost is 45,000 plus installation charge is 5,000 minus 10,000. 10,000 means the sales amount. Sales amount is equal to 10,000. Rupees 40,000. Yes. Sum of the useful life is equal to the 3 years we mentioned as 3 years. So, 3 plus 2 plus 1 is equal to, we have to add three numbers, is equal to 6. Calculation of depreciation factor. Factor means we have to calculate the depreciation during the year, that is 3 years. So, we have to mention particularly in 3 years separately. Year 1 total cost 50,000 into 3 divided by 6 is equal to 25,000. For second year, 50,000 into 2 by 6 is considered as 16,667. This is the depreciation charge for second year. For third year, 50,000 into 1 by 6 is equal to 8,333. At the end of the year, at the end of the third year, there is no value for machinery. So, we have to close the account in final year. These are the frequently question asked in, especially in depreciation chapter. What is mean by depreciation? Which asset can be depreciated? Which asset means only fixed asset can be depreciated. How often should depreciation? In normally financial account, there is a we mentioned the depreciation, we calculate the depreciation at end of the year. In depreciation, a source of income? No, absolutely not. This is a expense or considered as a loss. Is depreciation a cash expense or not? In previous slide, I already told that it is non-cash expense. How many types are in there? There are basically there are 5 methods are there. Further, some more methods are there also available. The reference book is wrote by Reddy and Murthy, Financial Accounting in the year 2018, published by Morgan Publications. These are the familiar financial accounting websites. You can refer it. Finally, I conclude the presentation. Thank you all.